Hello everyone, welcome to today's episode featuring Saurabh Chugh, Director of Equities, and Stephen Tan, Managing Director and Co-Head of Sales at Fullerton Fund Management. Fullerton Fund Management is an active investment specialist with expertise in equities, fixed income, multi-asset, alternatives, and treasury management. As part of the multi-asset management group Soviora Holdings, a company under Temasek Holdings, Fullerton has a track record of delivering strong investment performance across multiple asset classes. They have also been recognized for their exceptional performance in the investment landscape, managing the Fullerton Lux Asia Focus Equity Fund, which was awarded the Best Risk-Adjusted Returns Fund in Asia ex-Japan Equity by FSM Choice Award 2022. They also managed Fullerton Lux Asia Absolute Alpha Fund, which was named FSM One's recommended fund for year 2022 and 2023 in Core Equity Asia Pac ex-Japan. With a commitment to excellence and a strong track record of delivering value to their clients, Fullerton Fund Management is an organization that investors can trust to help them achieve their investment goal. Welcome to iFAST TV, guys. So what do you think of my introduction? Is it good?
Indeed, it's very good. It's informative, it's succinct, it tells us who we are, but honestly, it doesn't really tell you why anyone should be listening to us.
Aha! It's actually an introduction written by ChatGPT.
That's interesting and intriguing, and honestly, that tells me what ChatGPT should be doing is doing it. In the sense, it's telling you factual information. But just to make a point, right? Investing is not just about factual information. Factual information forms the basis of investing, but there's much more to it.
Indeed.
Our topic today is what ChatGPT can't tell you about Asian stock investing. Nowadays, ChatGPT has been all over the media for its insane ability to answer anything. But can it really answer everything accurately? Today, we will take a deep dive into how professional managers implement strategies for their top-notch Asian equity portfolios, and they will also answer some questions that we have on investing in stocks and funds in this current climate. So, the first question for the both of you: how do you pick good stocks for the funds that you all manage? So, according to ChatGPT, it says that you have to research on the company, analyze the industry, evaluate the stock's valuation, and diversify your portfolio. Stay informed. So, what do you guys think of this answer?
Thanks, Isaac. Maybe I can start with a quote from Sam Altman. He's the CEO of OpenAI. And I quote, "ChatGPT is incredibly limited but good enough at some things to create a misleading impression of greatness. It is a mistake to rely on it for anything important right now." Unquote. So while ChatGPT is great, I think we better leave investing to professionals like us.
Yeah. Thanks, Stephen, for that. I think, and just to add on a couple of more points to that discussion, right? Interestingly, there have been a lot of academic studies over the past few years which indicate that AI is good at a lot of things, but one thing it is not very good at is actually generating superior returns or picking stocks, because many times a lot of people spend lots of dollars to come up with an algorithm, but the decay in returns is very, very fast as well. So that's one point to kind of keep at the back of your mind. Your second point, I think what ChatGPT said on things to do to find good stocks and generate returns is not wrong. It's absolutely correct, to be honest. But the issue is that theoretically, it's the same thing that you learned in any textbook when you went to college to study any business school or any economic school, right? In practice, it's very, very different. And as professional fund managers, right, I think there are two or three things that we bring to the table, which I think is difficult for people to replicate. One is the ability to have lived through cycles, and the behavioral aspect which comes to it, to having seen different cycles of how stocks behave, and that's something honestly you have to live through it to be really comprehend or appreciate how things move, and keep a calm and cool head when things are moving in all directions around you.
I also realized that, from the answer that ChatGPT provided, there is very model answer. But what is the right answer? Like, for example, how do you analyze an industry and evaluate a stock valuation? There's a lot of things that is subjective, right? So with your experience, with a professional experience, that will then come in to make those information meaningful, right? Okay. So the second question that I'd like to ask the both of you is, how is a typical discussion like before deciding whether to buy, to sell, or to hold a stock in the portfolio?
No, great question. And discussion or debate is at the very heart of forming a 360-degree view on a potential investment. Typically what we do is, right, when we look at a particular stock is, right, we use a combination of qualitative tools as well as some machine learning models to come up with potential ideas of which could be good investment ideas. But once we have done that, then it goes through a whole due diligence process where we go out, we'll typically meet the company, we'll meet their competitors, we'll meet their suppliers, we'll meet industry experts to again form a view on the different things, right? So if you start from the top, you need to form a view of whether this industry is attractive or not. Say, for example, if you're looking at example of, say, electric vehicles, it's an attractive industry. We think its sales are going to continue to grow at 30-40%. Good enough. Maybe it's worth looking at some companies in the sector. But then you go down to the next step, whether which company has a competitive advantage, or the skills, or the management, or the technology to succeed in this industry, and can they maintain their market share or gain market share? I mean, those are the kind of questions we will ask, because in the end, what are we trying to ascertain, or what we are trying to basically find companies which can compound earnings and cash flows at a good rate for a very long period of time, and then buy those companies or stocks at a reasonable valuation. So there are two parts to it, as I said earlier, right? One is to find companies which can compound earnings and cash flows at a good rate. That's point number one. And all the things that I mentioned earlier are essentially contributing to that. The second part of that discussion is equally important, is what's the right price to pay for it. You alluded to earlier, right? Your valuations can mean different things to different people, or can be different for different companies. What we try to do is obviously, have a very disciplined target prices on each and every company we look at, in the sense what we think is the fair value of that particular investment. Now we could use different methodologies. We are not prescriptive. It will vary depending on what the company is, but essentially it boils down to the fact that the company must be able to generate returns above its cost of capital, and then if a company is doing that, you are willing to pay up a certain multiple or a DCF valuation on that, right?
So one thing I really like about what you have shared with me is that there's a process to evaluate, to decide when to buy, when not to buy, right? So it's not purely like, basing on emotions, where a lot of retail investor invest with emotions, invest with, what their friends say. And I think that is what ultimately allow institutional investor to be more successful in their investment journey over a long period of time.
Indeed, that's probably one of the most important aspects, and there is a whole science behind behavioral finance. If you're interested, you can read up on it, but a lot of it is about essentially keeping emotions at bay, which honestly is very difficult even for professional fund managers. But that's something that we always try to do, to have a process around it, so that even the analysts and the PMs kind of stick to that the discipline. Maybe I'll give you an example of a stock which did very well for us in the past, and there's a company in Singapore which all of you probably know of, C Limited, right? They own Garena, the largest gaming platform. as well as Shopee, one of the largest e-commerce websites, right? Now, this stock has had an interesting run, right? It was one of the best performing stocks in the region, in fact, globally in 2020, 2021. But then it had also fallen off a cliff and has lost a very significant amount of value in the last 12, 18 months as well. We were invested in the stock at one point in time because we did think that, when we did go in, that both the gaming business and the e-commerce business had a lot of value in it, and we actually the stock did very well for a long period of time. But when the broad environment changed back in late 2021, we had to take a very disciplined call that the interest rate environment is not the same, which means that the cost of capital for this company has changed, which means their ability to tap on the markets to fund their growth has changed. And on top of that, the growth outlook for some of the businesses was not what it was during the COVID era. So even though you like the company longer term, a good company and a good stock can be very different things. And you have to take a very disciplined call that yes, this is still a good company, may not be a very good stock for investors, and you have to get out when you need to get out. So we took that call that we would, even though we thought that it was still a good company, we decided to get out of the stock because we felt that the valuations did not justify, or the current share price was a bit excessive versus the growth fundamentals.
Yeah, I think this is a very important point. I mean, when advising clients, I see this quite a fair bit, that people tend to fall in love with their investments. And when they have done well in a certain asset class or in a certain sector, they tend to gravitate back towards the asset class and the sector, seeking the same returns. So this is something that's very important. I think as professional managers, we are able to take away the emotions a bit better. I mean, we are still human beings, but I think quite clearly that is a value add of a professional investor that is able to differentiate between the two.
So I have a curious question. When your analysts disagree on certain findings, right? So who makes the final call and how will the conversation go from there?
Very interesting question, and it's quite fundamental to us that people disagree on things. Or what I mean is that there's a healthy debate on each and every issue that we discuss, or each and every assumption that we have in our investment models. And it's part of our culture, to be honest, that that people are able to actively criticize or engage in a very healthy debate without having any hard feelings. And that's something I think which is very fundamental to investing, that you need to question each and every assumption of yours all the time. And so it happens quite often that analysts will disagree with portfolio managers may not agree with what the analyst is recommending, and vice versa. In fact, whenever we come up with an investment research thesis, we are actively encouraged to shred that thesis to pieces, right? In the sense that you find holes in that thesis. And it happens all the time. But to answer your question, that what happens in the end, if we are not able to come to a middle ground or something where we can agree on certain things, in the end, we do know that we need to take a decision on a certain investment, whether to go for it or not. And the process is designed in the sense that after this active, robust debate, the portfolio manager will consider all sides, but the lead portfolio manager for every portfolio or every fund that we run has the absolute discretion to decide on whether she or he wants to invest or not invest in a certain stock.
Okay, so there's a very good way of discussion, and also to leave no stones unturned, to challenge the thesis and idea before deciding to go into a investment idea. So can you guys perhaps share 5 tips on what people can do when the stock markets are dropping? Okay, so once again, according to ChatGPT, it says When the market is dropping, stay calm, right? Revisit your investment goals and strategy. Okay, diversify your portfolio and take advantage of buying opportunities while keeping a long-term perspective. So what are your thoughts?
Stephen, you want to go first?
Yeah, perhaps I could introduce a framework that I use for myself. So I would break my money into 3 buckets. You have your investment bucket. This is the meat and potatoes. You're supposed to deliver a return, a stable return. And of course, that depends on your risk profile. The second bucket, it's a trading bucket. So it's a bucket where you make some, you take profit, you lose some, you cut your losses. And the third bucket itself, it's your punting bucket. Yeah. So sizing it is very important. My kids' education, my retirement funds will go into the investment bucket. I get, say, average return over a market cycle that is quite achievable. And the profits from that year's return, I could use it to trade. If it's up 20%, I take profit. If it's down 20%, I cut loss. So technically, I won't lose my money. Basically, because I'm trading my profits. The third bucket, it's the punting bucket. So the trading gains that I get, I'll put into the bucket. So what will you actually put in the bucket? Essentially, think of it as a night in the casino. Bitcoin maybe. So if you observe this model itself, I think you'll be okay. The problem and the issue sometimes I see is where people start putting their investment money into the trading bucket, or God forbid, into the punting bucket. This is where you're playing fire. So as long as you observe that model, I think you should be fine.
Okay, so basically when the market starts to be very volatile with a lot of movement, staying calm is a basic behavior that we must have.
Of course.
And then is things beyond that comes from experience, come from knowledge, come from research that will make a difference. So if the fundamental of a calm behavior is not even there, then it's basically a formula for disaster lah.
Yeah.
Okay.
And I think this thing will be even more important. Stephen alluded to earlier about the 3G environment, and one of the things that we expect will be in abundance later on is volatility, right? So there were a lot of people who lived through this, through the COVID era, when there was a one way up for the market after the central bank started pumping money. But now we have multiple forces, right? We have geopolitics on one hand, we have the inflation dynamic and the associated interest rate environment risks on one hand, plus the fact that companies are operating in a very different environment at this point in time. So it's important to stay focused on the long term if you really want to make returns in this market, and remain disciplined in the end on what price you're paying for these for the assets.
Thank you for the tips, Saurabh and Stephen. And with that, we will end this episode. But do stay tuned for part 2, where we will answer more questions that you may have for Fullerton Fund Management. Thank you, everyone, and see you in part 2.
Thank you.
Thank you.
Thank you.
Thank you.